Hi there. Thanks for tuning in. Today, we're going to be doing an updated valuation of Playstudios Inc. This is the very first stock analysis video that I did. I did it over a year and a half ago, and now I want to do a full update on it because the situation has changed, and there will be some admission that I'm wrong and some talking about what changes in my analysis methods in order to make my analysis more complete in the future. So let's start by talking about Play Studios itself. So they own a lot of different apps, mainly games on mobile. So most notoriously, they have Tetris. They have the license to it, the official Tetris app on the Google Play Store or the Apple App Store is Play Studios game. They also have a ton of other casual games. They have Mahjong, they have Solitaire, they have Sudoku, and they have a bunch of slots games, and those slots games are also big cash cows for them. So what they've been talking about a lot lately, and a reason why the Play Studios company maybe is struggling a little, is because audience acquisition is more difficult than ever. So the costs are rising. There's even more competition. At the end of the day, they're part of the attention economy. These apps, you would think, commonly compete against other mobile games, for example. So Tetris, well, it competes against Solitaire, it competes against Pac-Man. The reality is they compete against TikTok. They compete against Netflix. They compete against everything that can take my attention in my free time. So, with that said, it's very complicated for them to retain people. And their solution to this is to have the Play Award platform where essentially you get a currency for playing all of their different games, and then you get a VIP service or player progression, so you get to show off that you're a VIP. And then you can also redeem rewards such as gift cards for playing a lot of Play Studios games. That makes it so you stay longer in the game. For example, if I play Tetris, and then I see that if I play for a little longer, maybe a week or two more, I could potentially get a gift card, a $5 gift card for something. Well, I would probably stay there longer. And if I know of another Play Studios game, well, then I can play for that one because I'll also earn the same currency to get those rewards. So that's the situation with Play Studios. They basically give some more retention. So you see, they never look at the store where they kind of talk about where all the rewards are there. If you never look at the store, then you are retained for a lot less than if you do, or even more if you purchase. So that's where it's at. You play a lot more if you redeem stuff or purchase stuff than if you don't. So it's very interesting. Although, of course, people who purchase stuff in Play Studios games but don't redeem gift cards still make them more money than people who do, but those still make them more money than people who don't even purchase or view anything, of course. So even if they're giving a little bit of gift card money, these people probably make them way more in the long run than these two people who just view the store and don't either purchase or redeem anything in terms of loyalty. So that's important to note. Now, they're basically shifting their advertising a little bit. So now they want to make more money through advertising. They want to make less money through in-app purchases. Why? Because advertising has way higher margins. There's no platform fees, and they can scale that a little better. So that's very important. They want this pie to grow in general. And I think that's fine. I think they can control advertising a lot better than they can control in-app purchasing. It would be a risk to the business if all of a sudden Google Play or the App Store say, we'll take a 50% cut of in-app purchases. So it's important for them to take control of their own business like that. Now, the largest category of titles for Play Studios is casual. They have a bunch of casual games and they have casino games. And this is basically the total addressable market that they have. They're a $200 million company addressing $23.5 billion worth of games, and that's probably going to grow. So that's important. Now, they only have stuff in the brand puzzle and casino sectors. They can expand into other things, adventure and simulation games, RPG and strategy games, arcade and action games. Interestingly enough, they did have arcade and action games in their portfolio, but they offloaded that to another company. Now, they do have cash. So they have cash in their portfolio, 133 million. Now it's about 90 million. They have a revolver. They have a positive cash flow generation, which we love to see. And they do have 50 million available to repurchase shares. They actually repurchased shares recently. So even compared to the last time I analyzed them, they have less shares now, which as an owner, you own more of the company. That's what you're going to see. So it's interesting because they want to grow by doing acquisitions in awards, gaming, or both, and then growth investments in current businesses. So they're going to reinvest a lot of the money that they make. They're going to be constantly reinvesting in either new games, new companies that produce games that they can acquire, or just in expanding the loyalties program. So a lot of this cash will go way back into the company. That's very important to note as well. And it sort of shows here. So, for example, if you look at the revenue, well, first of all, the revenue growth has been slowing down from 12.7% growth in 2020, although that one was because everyone was at home, to 1% growth in 2022, 7.1% in 2023, and it's expected to slow even more in 2024. We're talking also around 1%, if that. So their gross profit, on the other hand, has been growing. As you see, selling one more game is costing them less and less every time, probably because they're making more money from ads and less platform fees are involved. But the operating profit is actually negative right now. One of the reasons why is, as we were saying, as they expand operations, they have to hire more people to develop more games. They have to buy different companies that do that. So the operating profit is really tricky. They're doing research and development. They're doing all sorts of things, spending in ads, spending in marketing. I'm sure they have a monster marketing spend to even put those games in the eyes of players. So that's where it's at. And also the return on investment capital went from very positive to turning negative. So that's something we don't like to see and something that you have to live with as an investor in Playstudios. All of a sudden, it's a pretty decently profitable gaming company to one that is sort of finding its footing through growth and through competing with other, maybe even bigger businesses in the attention economy. So I'm going to do a discounted cash flow model. The variables here are going to be an 11% required rate of return for me. That is 1% more per year than the market on average, and that adds up to be quite a lot over time. And then a 3% perpetual growth rate. So we're going to plug in the free cash flow value. We're going to say it's about 7% of revenue that gets turned to free cash flow. So this is going to be 7% of their revenue from 2024 onwards. This is with predictions that revenue is basically going to go down in 2024 and then just start growing at a smaller rate from 2025 onwards. That 3% rate pretty much holds. And if you put this all in a discounted cash flow model and divide it by the number of shares out, which is 124.7 million right now, the fair value that you get is of $2.07. However, if you add the net cash that they have, then you get a value post debt of $2.83. Now let's look at where the Play Studio stock is right now. But first, let's compare it to my previous discounted cash flow. So in that one, I said that it was actually worth $4 with 62 cents. Now, my free cash flow numbers here are way higher. For example, you see that for 2024, I was estimating $20 million of free cash flow. Here, I'm saying nearly 40, so they've just about halved. Why is this? Well, the reason why is because in my original analysis, I did not subtract stock-based compensation. And that's a problem because that gets added to cash from operations, but in reality, it's an expense. And companies like these usually have a whole lot of stock-based compensation. So that's something that I make sure to be doing pretty much in every stock analysis I've done in 2023 onwards. But this is something that I corrected and really matters when you're looking especially at those tech companies that are growing because they usually issue a ton of stock to employees. That's important. And that's the biggest change that I have here. Another one is simply a little smaller growth projections. Between those two factors, you have a more tempered free cash flow estimate that I think is more aligned with the reality. Now, the value of Play Studios right now is $1.70, and the market cap is around 212 million. That's about what we have in terms of information. It doesn't even have a P because its net earnings are negative. So where does that leave us? First of all, was I too optimistic in my first analysis? Well, probably. When I got this number of $4.62, it was hovering around here. It was hovering around this $3.60 value. I think at that moment, that valuation made sense. And I actually bought around here. It went up to around $5. I remember selling around here. And then when it came back down, I bought. And now I'm down about 50%. So half of the money that I bought back with is gone. But essentially, I broke even because I did make a profit the first time. I'm still holding Playstudios though. So let's talk it first if I was too optimistic. So at the end of the day, Playstudios does compete with absolutely everything. Nothing guarantees that its games will keep holding a steady stream of players in an attention economy. And I also just made the mistake of not accounting for the stock-based compensation. That was very costly. Time frame is also just a very important thing. So Playstudios can give you a good return, but it may take a very long time to play out, or you may have to be having a really good eye and seeing when do you get out exactly. For example, if right now it's at this 170 level and I say, okay, it's actually worth these $2.83, I may have to have a really good eye for investing in it now and then selling when it gets to that level or a little bit past that level, because then it may report a bad quarter and crash back down to here. As you see, there's these precipitous movements here and there. Those are very clearly marked. Anyways, I think at the end of the day, it's undervalued right now, according to my valuation, relative to the price of today. However, you have to understand that this company comes with its risks. A competitive landscape, a constant cost of development and acquisitions makes future cash flow growth a slow and difficult prospect. Essentially, yes, they will be cash flow positive. I think it's great if they're cash flow positive, but they always have to be acquiring new game companies, acquiring new games, making new things. So they do have a lot of overhead to work with, even though selling a app costs them basically nothing. Nevertheless, it still generates positive cash flow and it doesn't dilute you the way other microcaps do. A lot of smaller companies are constantly issuing shares. It's not that Play Studios doesn't do it, but they have bought back shares before. And the thing that becomes important with companies like these is, can they dilute you quicker than they can return money to you? And so that's something that you as an investor would have to watch very carefully. You could do a lot worse than investing in Play Studios, though, but you have to know the risks, which is everything I've been talking about here. So I think we have to ask ourselves, who do they really compete with? And you have to ask yourself that with every single company that sells to people's free time. That's the same with Netflix. That's the same with anything like YouTube or TikTok. It's just so complex, right? And then you have to ask, what do they offer uniquely that would retain people there and would make people not go to a different service or literally spend their free time doing anything else, going outside, you know? So that's where I'm going to leave you. I think this was a great analysis because I can look back retrospectively at how far I've come, reflect a little bit, and see that these analyses will continue being stronger for it. Thank you very much for watching. Have a great rest of your day.